In July 2025, the United States government signed a piece of legislation that most financial analysts described as the Crypto Regulation Bill. They were half right. The Genius Act, the Guiding and Establishing National Innovation for U.S. Stablecoins Act, is the first major federal crypto legislation in American history. But if you read the White House's own fact sheet, the intent is stated plainly. The goal is not to regulate crypto. The goal is to ensure the continued global dominance of the US dollar as the world's reserve currency, using crypto infrastructure to do it. That is a different story entirely, and for anyone tracking the economic sovereignty of global South nations, particularly across Africa, it is one of the most consequential policy moves of the last decade. Today, I want to tell you exactly what happened, why it matters, and what the strategic implications are for markets, governments, and businesses operating across the global South. Let me establish the mechanics first, because the strategy only makes sense once you understand the architecture. A stablecoin is a digital currency pegged to a stable asset, most commonly the US dollar. Two dominant stablecoins globally today are USDT, issued by Tether, and USDC, issued by Circle. Both are dollar pegged. Both operate on decentralized blockchains. The Genius Act changes that. It requires stablecoin issuers to back every token with 100% liquid reserves, US dollars or short-term US Treasury bonds. It subjects issuers to anti-money laundering compliance, regular public disclosure, and federal oversight. It brings the entire stablecoin ecosystem inside the US regulatory parameter. On the surface, it looks like a consumer protection measure, and it is in part. But the structural consequence, you have to read carefully. Every dollar-pegged stablecoin in circulation globally now requires a corresponding U.S. Treasury bond or dollar reserve held inside the U.S. financial system. Tether and USDC already hold more U.S. Treasury bonds collectively than the sovereign wealth of Saudi Arabia. As stablecoin adoption grows, and it is growing very fast, the demand for U.S. Treasuries grows with it. The U.S. government has effectively created a mechanism by which global crypto adoption indirectly or directly finances American sovereign debt. That is not an accident. That is the design. Now, this is where this becomes a global South story specifically. Africa is not a peripheral player in this system. It is one of the fastest growing nodes. Stablecoins now account for 43% of all crypto transactions across sub-Saharan Africa. Between July 2024 and June 2025, on-chain activity in sub-Saharan Africa reached $205 billion. That's a 52% increase year on year. In Nigeria alone, stablecoin transactions totaled $22 billion in a single 12-month period. In South Africa, stablecoins have overtaken Bitcoin as a dominant crypto asset. The South African Reserve Bank has formally flagged stablecoin as a new systemic risk, noting that digital assets are bypassing the country's exchange control regulations, which were simply never designed to cover them in the first place. And critically, the stablecoins driving the adoption are overwhelmingly dollar denominated. USDT and USDC together account for the vast majority of volume. So why are African users choosing dollar stablecoins at this scale? The reasons are practical and entirely rational. Local currency volatility, foreign exchange shortages, cross-border payment friction, the cost and speed advantage of blockchain rails over correspondent banking. In markets where inflation erodes purchasing power and the banking system is slow or inaccessible, a dollar-pegged digital token is a genuinely useful instrument. But here is the strategic paradox that almost no one is naming clearly. The same communities that are building narratives around de-dollarization, around BRICS, payment alternatives, around African monetary sovereignty, around the decline of dollar hegemony, are simultaneously adopting dollar-denominated digital infrastructure at scale from the bottom up. Not because they are being coerced, but because the dollar stablecoin is currently the most functional tool available for the problem they are trying to solve. The dollar is not losing Africa through stablecoins. It is being re-embedded voluntarily, transactionally, at the retail level in ways that no sanctions regime or trade agreement could achieve. These are real trends. The direction is correct, but the stablecoin story introduces a countercurrent that the de-dollarization thesis has not fully absorbed. While governments and central banks are working slowly institutionally to reduce dollar dependence at the micro level, private citizens and businesses across the global south are making individual decisions every day to hold and transact in dollar-denominated digital instruments. The IMF noted in its 2025 external sector report that growing global stablecoin adoption could reinforce the United States' position as the world banker, increasing demand for treasuries and expanding the stock of U.S. external safe liabilities. In plain terms, the more the world uses dollar stablecoins, the stronger the structural case for the dollar's continued centrality. This is a genuine tension at the heart of Global South economic strategy, between the sovereign aspiration toward monetary independence and the daily commercial reality that the dollar-denominated instrument is simply more useful to use right now. Understanding that tension is the beginning of a serious strategic position. So, what are the strategic implications for governments, institutions, and businesses operating across the Global South? Three things. First, the regulatory arbitrage window is closing. For years, dollar stablecoins circulated outside formal regulatory frameworks, which created both risk and flexibility for Global South markets. The Genius Act changes the U.S. side of that question permanently. It also has extraterritorial reach. Foreign users who want access to U.S. markets must register with the Office of the Comptroller of the Currency and hold reserves inside the U.S. financial system. For African regulators, this means the de facto dollarization of local crypto markets is now backed by U.S. federal law. The question is no longer whether to respond, it is how fast and with what framework. Second, the stablecoin infrastructure question is now a sovereignty question. The EU recognized this immediately and has developed its own framework under MiCA, the Markets in Crypto Assessments Regulation. Hong Kong passed its stablecoin ordinance in May of 2025. The African Union and individual central banks are significantly behind on this architecture. A continent where 43% of crypto flows are dollar stablecoins and where that share is growing needs a position on digital currency sovereignty, not as a theoretical policy question, but as an operational one. Third, the narrative infrastructure around this story is almost entirely absent. Most coverage of the Genius Act is written for a U.S. or European audience focused on consumer protection, regulatory clarity, and crypto market structure. The Global South implications, the de-dollarization risk, the sovereignty tension, the strategic positioning question, are not. They're not being covered at the level of analytic depth that this moment requires. So the gap is both a problem and an opportunity. For policymakers, it means the frameworks being built in Washington and Brussels are being built without serious input from the markets most affected. For analysts, advisors, and businesses operating across the Global South, it means the competitive advantage right now belongs to whoever is paying close attention, while the consensus narrative is still catching up. The Genius Act will be studied for decades as one of the most elegant exercises in monetary statecraft, particularly in the 21st century. It took the decentralized anti-establishment energy of the crypto movement and redirected it through legislation into a mechanism for extending dollar infrastructure into every market that a traditional bank could not reach. The dollar didn't need to win the geopolitical argument. It just needed to be the most useful tool in someone's pocket when they needed to send money across the border, hedge against inflation, or settle a trade. For the Global South, the question is not whether this happened. It has happened. The question is what a serious strategic response looks like at the level of regulation, of institutional design, and of the narrative frameworks we use to describe what is actually at stake. I covered the other side of this story, the de-dollarization thesis, and what it means for brand positioning and market in a separate video. The two videos sit in tension with each other deliberately because the reality they describe is genuinely in tension, and that tension is where analysis lives.